It seems that when people were dealing with Madoff, the concept of diversification that we all learned as a bedrock principle of investment went out the window. The allure of these consistent returns month after month with few down months was just irresistible. And then as the feeder funds got into the action, this expanded on a global scale. And there are investors, both individual and corporations, all over the globe. Now, how did the scheme operate? This, I think, has also been, at least at one level, pretty well described in the press, although I think there are many layers of the onion still to be peeled away in terms of who else was involved along with Madoff, who actually had the knowledge staring them in the face but didn't act. But Madoff went to investors on the idea that they were going to get steady returns because he had this great strategy called a split strike conversion strategy. Now, this wasn't anything unique to Bernard Madoff. Other people had run with this strategy before. The idea was that you would buy a basket of S&P 500 stocks. You would then hedge that position with options and puts and hope that your timing on the basket led to appreciation. Clearly, a strategy like that is going to be correlated to the market. Clearly, it's going to be volatile. Historically, the funds and the investors who have pursued this strategy saw that volatility. None of them ever saw the type of returns that Bernard Madoff promised. So when Madoff began to compile year after year and then into the decades, consistent 11% returns with only a few down months, this became hugely attractive to all sorts of investors. When it wasn't in the market, he supposedly was keeping the money in treasury bills. Now, how did he operate this so long without outside scrutiny? Absolute key fact was the lack of segregation of duties. Bernard Madoff was his own broker-dealer. He was his own clearing broker. He was his own, of course, investment manager. And critically, his company served as the custodian for the securities and for the funds. There was no one on the outside, leaving aside this three-person accounting firm, and we still don't know exactly what they did, who were supposedly auditing his books. But you had none of the segregation of duties that you would typically expect, where, for example, you would have a major bank serving as a custodian for the securities. Now, the fraud grew to enormous levels. Initially, Madoff's investors were friends and a few individual fundraisers. In fact, part of his evil genius was turning down people, saying, no, I really don't want your money. Our fund is closed. What better way to get people incented and focus on how do I get in on Madoff's fund than a situation where Madoff pretends not to want your investment to begin with. It turns out, though, that he was actually paying some commissions and kickbacks to a handful of facilitators who would steer funds to him from local communities, particularly country club communities in Florida, in Aspen, and here in New York. It's now estimated that an additional $28 billion came in through over 24 feeder funds, which I'll talk about more later. This is going on for so long. How come it wasn't detected? One of the key questions in this. Clearly, the SEC dropped the ball. I think this is probably the blackest chapter in the SEC's history, and if there's a blacker one, I hope we don't encounter it. This is not a situation where no one brought this to their attention. As you all know, they had explicit warnings, most prominently from Harry Markopolos, who went to him beginning in 2000, and in every year he went to him. And in 2005, he presented him with a comprehensive document that laid out over 20 warning flags, red flags, that included quantitative information, that included basic common sense information like, if Madoff has this great investment strategy, why doesn't he run it as a hedge fund and make the 2% and 20% rather than let all these feeder funds do it? How could you possibly have a three-person auditing firm handle a $65 billion fund? You had a big firm auditing one aspect of his business abroad. Why do you have a three-person storefront here in the United States? He even gave the SEC the names and phone numbers of sophisticated securities professionals who had looked at this, concluded it could not be legitimate, and refused to deal with Bernard Madoff. Those included for example, Goldman Sachs and Citigroup and other major financial institutions. So the SEC looked at this. They asked Bernard Madoff to register as an investment advisor, which he did, and that was about it. They never got to what was, in retrospect, clearly a problematical situation. Now, the fund managers also, as we'll explain, did not conduct meaningful due diligence. And just where their own actions fall, yes?
Excuse me, was this unusual, or did SEC, this was like a standard practice following up with?
I think this is unusual from what I've seen. There are other examples of where Ponzi schemes have been committed. I'm not aware of any other instance where one went on this long, right under the nose of the SEC, through a regulated entity, where the SEC was given explicit written information. This wasn't some call saying, by the way, I think Bernard Madoff is running a Ponzi scheme. This is documented information saying mathematically his returns could not be achieved, references to leading people on Wall Street who would corroborate that information, and the SEC did nothing. I certainly hope that isn't business as usual.